We better get things rolling. It's about bang on time. So, thanks for joining us. This talk or this webinar is going to be on your 90-day profit plan. And I'm going to talk through some concepts about how to get your business permanently profitable in less than 90 days. Each of the topics I talk about will have different strategies within them, and they may not all be applicable, but I feel like there's a ton of value and there's a lot of concepts in here that most businesses or all businesses should get. Some really practical things to walk away with to help implement and make your business more profitable. All right, I'll just get the slides up and we can get started. And I'll go down here in the bottom left so you can still see me. Cool. So, about Bid Ninjas. We help small businesses with profit first implementations and consulting. We do some business coaching and some virtual CFO engagements as well. Our bookkeeping is obviously very well known, and in fact, we won Bookkeeping Partner of the Year last year at the Xero Awards. And we also have a fantastic range of online education. So that's like group mentor courses, but also self-guided stuff if you're interested in digging into Xero yourself. So those are a few things that we do. Quick disclaimer, I'm a chartered accountant. I've got a lot of experience, but I'm not a tax accountant and I can't give you specific advice about your situation with this. So if you need more specific stuff, obviously reach out to your tax accountant for that stuff, or you can drop us a line if you want something more specific about your circumstances. Great. About me, why should you listen to me? Very good question. Well, I'm passionate about helping small businesses survive and thrive through this period. I've been with Bid Ninjas for over 3 years, but I've been an accountant for over 10 years. I was a chartered accountant at Ernst & Young and in auditing, and I've had a big career in both corporate and also now in small business. So I've got a good range, and I've seen a lot of businesses and trying to apply that experience to our clients here at Bid Ninjas. And those are my qualifications. So I'm a profit first qualified, certified profit first professional, chartered accountant, and financial coach. Great. Let's get into it. My goal, to outline a clear path to get your business permanently profitable in 90 days. Let's just have a quick reflection moment before we dive into it. How confident are you that your business will have more cash in the bank in 90 days' time? So 90 days, do you feel like your bank balance will be bigger or smaller? Do you even know if it'll be bigger or smaller? Do you know what's going to be happening in the next 90 days that might influence that? And now, I hope that the people that have asked or answered number one, how many people have answered number one? The people that have answered number one and number two, I'm hoping to slide you up into that number three category with some of these tips. And if you're at number three already, I want to help you grow and get more profitable and achieve those growth goals. So I think this is applicable across any answer there. So what are you going to learn today? The three big topics we're going to chat through are some cash flow tips about how to get more cash in the bank quicker, how to stop spending so much cash, and also how to forecast what's going to happen. All really important. I'm going to talk through some profitability hacks. So we're going to talk through margins, how to impact your margins, and some ideas about maybe how to become more profitable. And I'm also going to talk through some debt busting strategies. Australia has one of the highest levels of household debt in the world, and the businesses aren't far behind it. I think coming out of the pandemic period, a lot of businesses probably have taken on a lot more debt to get through it. So I'm going to talk through some debt busting strategies that I think are really applicable for the moment. And as a bonus, I'm going to talk through a little bit about how Profit First might be able to help you with a few of these strategies if you want to implement that. Let's dive into the cash flow tips. So cash flow is about the timing and flow of cash into your bank and out of it. You may have heard the expression before, but cash really is king. It should be preserved at all costs at the moment. You should be reducing the rate that you're spending it as much as possible. So that's obviously cost cutting, but I'll talk a little bit more in depth about that later. And the question when you're spending money is spending this money moving you towards your ultimate goal? Is the dollar you spend bringing in more dollars in revenue? Or is the dollar you spend improving the service for your customers? It should all be towards that ultimate goal. So It might involve tough conversations with staff and suppliers, obviously, if you're looking at the cost cutting stuff. And you should be monitoring this stuff regularly. In times of crisis, weekly or at least weekly. Um, but quite often, more often, the cash flows are done like a cash flow forecast is done on a monthly basis. This is an interesting graph about a company's income versus their expenses. As you can see, as a company launches and grows in the growth phase up to point A, their income's growing, but naturally your expenses grow as well because you're bringing on more staff or you're buying more products or you're investing in the business. And so they grow together. The problem comes in situation B here when something, say, like a pandemic hits and your income falls through the floor. There's a huge issue, maybe outside of your control, maybe inside your control. The market changes, but your expenses are so sticky that they stay high. A lot of those things, like especially your fixed expenses, if you've committed to a rental lease, if you've committed to hiring staff, those kind of things, you can't just immediately fire these people and quit the premises. So they stay naturally higher, even though your revenues drop through the floor. And that's when you start to hemorrhage cash. So it's about finding a way to either bring that income line back up or reduce those expenses to get down at least to a break even point. And as you can see, through point C into recovery phase, the income starts to grow and we start to meet it there to a more healthy level. Um, so yeah, that's an interesting way to think about it, and I thought it was a nice visual. Okay, quick quiz for everybody. Where is your cash hiding? You can type it in the chat or you can just think it. And for those wondering, this isn't beer. I had someone on a webinar ask me that last week. No, it's whiskey. It's not actually. It's English breakfast. All right. Okay, some people have gotten it, which is fantastic. Your cash is hiding on your balance sheet, funnily enough. So this is what your company is worth at any one point in time. So the boring accountant's way to say it is your a financial position of your business at any point in time. So your accountant should probably normally be giving you one of these at least at year end, if not monthly. Your cash is hiding obviously in your bank account. You're probably aware of that. And that's what sits on your balance sheet. Those who aren't aware of a balance sheet, it's got a breakup of your assets, the things you own, liabilities, the money you owe to other people, and it's also got your equity, which is what your shareholders or equity owners, what it's worth to them. So it's cash. So the cash is hiding in your bank accounts, obviously. Another one that I'm going to talk about is in accounts receivable, which is where people owe you money. So it's counted as a current asset, and I'll talk through about how to reduce your accounts receivable shortly. So that's one place you can find extra cash that your business needs. In times of crisis, businesses also look in their other assets. For example, you might be holding a bunch of inventory, or you might have a bunch of office equipment that you bought. That's also cash, and that's sitting as an asset on your balance sheet. So people might be selling that stuff down, looking to reduce their inventory levels. So that's another place that cash could be hiding in your business. Another one potentially is if you do VAT or GST, you might be owed a refund for this month or this quarter. So there could be cash coming in from the government there as well. So there's a few different places that cash can hide on your balance sheet. I mentioned accounts receivable. I saw this in a cafe once when I went out to the bush. It's awesome. In God we trust, all others pay cash. And I love that sentiment because cash is king, but in the modern world, most people are paying on credit card now. So cash inflows, these are some tips that hopefully will help you get more cash in your bank quicker. Some are behavioral and some of them are just structural. So what I mean by structural is the structure of your business is that you get paid up front or a percentage up front. Otherwise, the engagement doesn't go on. That way, you're ensuring you get cash up front. Payment plans is another structural thing that you can set up and minimize the cash hit to your customer and get them pay over time. Some people have like a big job. For example, if you're doing some of our agency clients who are doing a big SEO job might look to progress bill depending on certain milestones. You can invoice for this weekly and or monthly, depending on when you do it. A behavioral incentive is something like a discount for an early payment. That's trying to incentivize people with a carrot to get the cash across to you quicker. Similarly, you can also use not the carrot but the stick, which is implementing a late payment penalty. I'd advise against this if you can. You've got to remember that your customers were once potential leads, and the way that you courted them in that process is still the way that you should treat them once they're in your system and you're serving them. So look at your email copy. Are you being kind, generous, emotional to them, or are you just demanding money quickly from them? People are going to want to pay you more if they like you and if they feel like you've got their best interests at heart. So if you need to email them, you can do that, but I'd recommend picking up the phone and speaking to people about this stuff. And offering a range of options in so you can offer credit card payment, PayPal payment. The retailers love Afterpay. Giving people a range of ways to pay you is also really handy. It makes it a lot more likely they're going to do it. You can automate your invoicing in Xero and send automated reminders leveraging Xero software, which is really handy. And for the poor paying customers, you might want to limit your exposure to them. So don't get in the hole to them too much. I know, especially in the construction industry, a lot of people can go under with, someone's racked up debts all across town and then doesn't pay anyone. Great. So those are some ways to get cash into your bank quicker. Why you need to do that and why that I recommend to all my clients to run the accounts receivable aging report in Xero is that if we pretend that we are the lender in this diagram and that your customer is the borrower. So day one, your customer is really happy that you gave them what they wanted and their sense of obligation to you is high. You just gave them it. They're really appreciative. As time goes on, they forget the service or product that you've given them, and therefore your invoice is a lot less important to them. But as you can see, your need for the money goes up over time, and you start to get more and more nervous about getting paid. So you need to make that perfect middle way point. Usually the terms can be 30 days, sometimes shorter, sometimes longer. Immediate payment through a credit card is obviously the preferred way, I'm assuming, straight away. But you need to make sure that you're top of their mind by keeping communication open or getting paid really quickly. Cash outflows. So we've talked about some ways to get cash into your bank. This is some ways to minimize the cash leaving your bank. You can delay your AP. Again, speak to your suppliers, maybe push it out, explain your situation. If you're in a tight spot for this month and your cash flow is looking a little tight, you've got some big spending coming up and you need to keep some on hand for that. Another big one, especially for our agency clients, is staff utilization. So minimizing any unnecessary hours and making sure that all your key staff that you're paying a really good wage are charging to billable time. For team morale, this needs to be done in a really open, transparent, upfront way so people are aware of how their utilization affects the business's profitability. Because if you're paying, a skilled developer or you're paying anyone in the business a decent wage, say you're paying them 100 grand, but for 30% of their week or month, they're doing downtime. So 30 grand of their salary is not billable work and potentially is a hit to your bottom line or to your profitability. So tracking staff utilization is a real hidden killer in a lot of businesses. And I'll speak about it later, but making staff happy, productive, engaged is going to be the way to keep that up. Delaying or eliminate unnecessary capital spending for those looking at big purchases. If things are looking tight, you can wind that back. So don't spend it, don't buy that laptop, maybe don't get that new car. For our e-com clients, if you can, minimizing your inventory replenishment, reduce your stock levels so you don't get caught with a huge amount of stock on hand. I mentioned earlier how the balance sheet hides cash. Your inventory sits on your balance sheet. So if you've got a huge amount of inventory sitting in a warehouse somewhere and no one buying it, that's a lot of cash tied up in that stock. So if you have less inventory there, less cats tied up, more in your bank account, more that you can use for other things. And then also look to maybe lease equipment instead of buying it and renegotiate these for a better deal if you have a lease. Okay, let's look at cash flow forecasting. Is everyone getting value from this so far? Great. Awesome. So, as you can tell by this guy on the boat, is looking ahead. It's trying to see what's coming up on the path or in the ocean for your business, and trying to predict problems or have a look at opportunities that you can capitalize on coming ahead. And this is a really, really, really important tool for any business. It doesn't matter the size, and I think it's crucially important to be doing now more than ever. So, some quick concepts. How much money is in your bank is your cash position or your opening cash balance. That's your starting point for the forecast. How much cash you're using each week or each month is your cash burn rate. How much are you burning through your cash? So that's how many expenses do you have? Where are you spending it? How quickly are you going through your cash? And how long it will last is your runway. So if you've got a big cash position and you're burning through it slowly, you're going to have a long runway. If you've got a small cash position and you're going through it quickly, you're not going to last very long. And there's a million stats out there, but majority of small businesses and small to medium businesses, they fail due to cash flow issues of one reason or another. They might have product market fit, but they can't manage their inflows with their outflows and they go belly up. So this is really, really important stuff. So some more 101 with forecasting. Most businesses will probably look at some sort of rudimentary key performance indicator for their business. So that might be you look at your sales. Most immediately look at their sales. That's the number one thing they do, or their revenue. Some interesting ways to think about it and how this will flow into your cash flow forecast is that your key performance indicators are like your beacons that track certain things, key things, in fact, in your business, and they drive your business success. And these will feed into something that we call a driver tree. And your driver tree ultimately will feed in to your how much value you create in your business. So it's really crucial that most businesses they don't have to have too many. I don't want to scare you with too many metrics, but a couple of crucial ones. Some leading indicators are the forward-looking ones. They're up ahead. So the new leads coming through the door, how your conversion rate for these leads. And another leading indicator some forget about is customer and staff satisfaction, because customer satisfaction means potentially referrals. Staff satisfaction potentially means better utilization, more productive, happier customers, more profitable because you're paying them a wage and they're being used the whole time in something productive. So those are some things you should be tracking. There's a bunch of handy apps about customer and staff satisfaction out there. Lagging indicators, those are kind of the backward looking ones, and they're behind the leading. So revenue, profit, or your net promoter score is another common lagging indicator that some people will track. So how these kind of flow into what we call a driver tree, and we use this when building someone's cash flow forecast. So as I mentioned, a leading indicator like conversion rate, your conversion rate will obviously lead into your number of customers. Your number of customers will drive into your revenue. Your revenue obviously drives into your gross profit, which drives into your final net profit that you can take home as the business owner. So these lead indicators are really important to track because as you can see, it all flows through to creating a business value. And you need to be assessing whether these KPIs will be the same in the next few months. And you're using a combination of the leading indicators and the lagging indicators to try and work out what's going on and what's coming up ahead. So, quick break. What drives a profit in your business? Have a think about it. Is it a top performing product, a key service you deliver, or a key client you looked after? Who is the bankable check in your business? You might have a best selling item. Have a think about it. And do you have metrics to track that as well? How do you know if that client is happy? How do you know if that service you deliver is being done in the most efficient way with the best staff possible? If it's a product, do you know you've got enough on hand? Are you checking your reviews on that product to make sure there's no quality control issues? So there's some ideas about indicators you can track that lead into the driving the profit in your business. Let's talk about forecasting. As I said, it's a forward-facing document. It's a living, breathing document. When we build it out in our cash flow consultations with people, we do a rolling 12-month forecast. So each month you dive back in, predict it out for another 12, and that's a good way to keep your eyes ahead. The profit and loss and balance sheet are great, but they're historical documents. They told you what happened. Now, they're not useless though, because they are a fantastic base when building your forecast, because you're going to be looking at last year's sales and revenue figures and then making adjustments based on your KPIs looking ahead. So you're analyzing the past trends of where things are going up or down, and then you're also using your lead indicators to help inform whether that trend is going to continue or there's things ahead that might affect it. So some other cash inflows you should think about when plugging these into your forecast. Are you getting some tax refunds back? Some government grants, which there's been a lot of recently. Is the owner going to have to tip in more funds? Do you have to make loan repayments or loans being repaid to you, I should say, collecting your debts? Are you planning any asset sales? Are you trying to unlock some cash from your balance sheet by, selling some of your inventory, selling that computer you're not using, stuff like that? And then also, is there any royalties that are coming in that isn't maybe included in your normal revenue lines? So those are some inflows you should be ensuring that you include in this forecast. And then on the flip side, the cash outflows, you're doing an expense forecast. So this is not only the direct costs used to deliver your product or service. So these should be related to what your sales forecast is going to look like. If you're predicting booming sales, there's going to be some direct costs that are going to go up with that, and you need to make sure you adjust. Maybe you're going to have to hire another staff member. Maybe you're going to have to buy more stock. Maybe you're going to have to invest in a better website. So these might flow up with the boom in sales. And then other things, obviously, your advertising, staff costs, rent, subscriptions, administration, all those other things that you know are costs in your business. Have a look at how that looks ahead for you. Maybe you've managed to renegotiate your rent, that might go down. But maybe you want to increase your advertising because you're getting good ROI at the moment, and that might go up. Some other cash outflows to think about, some people forget about, buying new assets. So if you're going to buy a new website to help fund your growth, you're making loan repayments on a car or an equipment or on anything, and any other loan repayments. Is the owner going to need to draw funds from the business for any personal things coming up? If you've got your wedding coming up and you as the owner might need to be funding that, have you predicted that? Are you going to be needing to take more from the business at a certain point in time? And do you need some funds from this business to invest somewhere else? So make sure you build all of these things into it, not just your basic sales and expenses. This is how one looks that when we run our cash flow consultation. This is the template we provide you, and then we build it out together. I ask you a whole bunch of questions exactly based on your specific business needs, and then we try and get a handle of it. And so you can see the opening cash on hand is where you start, cash position, and then you've got your cash receipts and your cash paid out. Another really useful thing we do is something called scenario analysis, where we build out your baseline, but then we also build out your best case scenario for the 12 months ahead, but also importantly, your worst case scenario for the 12 months ahead. That's really handy. So people have a game plan in their back pocket in case things fall off a cliff. You know the adjustments you were going to make. You've already thought them through. You've already imagined that reality. And that might include, bringing staff down to 4 days a week, renegotiating rent or going into a cheaper place, reducing your contractors for a few days a week, taking an axe to your software subscriptions and trying to reduce those. So you've got a plan for when things might go down. And you'll notice when we do this with people, they find a lot of fat just naturally and realize that a lot of these things they haven't looked at with a critical eye before. And there's a whole bunch of adjustments that get made in people's businesses after doing this. So it's a really good overall refresher on what their business is doing and each of the line items. So I mentioned the trends before, looking at previous balance sheet and profit and loss. The trend is your friend. Make sure you have a look at what that's doing, but also don't just assume it will continue. Try and consider all the information you have relevant to you now to see whether that trend is going to continue. Underestimate your revenue and overestimate your expenses. That's trying to take a conservative approach to give yourself a bit of a buffer. So we obviously do your most realistic scenario, but then we also do best case, worst case, where you can kind of get a bit more ambitious or negative. But your main forecast, if you're only doing one, try and be conservative with it. And then be clear on the timing of when cash will hit your bank account. As I said, how so many businesses fail due to cash flow issues. If you've got a huge invoice, but they're not going to pay you for another 90 days, and you've got to meet staff payroll this month, that invoice is no good to you this month. So you need to be clear of when that timing is going to hit the bank and how you can align those things for the big expenses with some revenue to come in to give you the cash to fund it. Make sure you think about your tax debts. Have you got a tax payment plan you need to be servicing? A lot of people forget about that one and need to build that into their cash flow. Keeping your books up to date is critical. So make sure you have a bookkeeper, like Bee Ninjas, or do it yourself and just do it each month or week, whatever kind of schedule you're on, because that will help you when you're building your forecast. You've got the most relevant numbers for the month just gone. You plug them into your forecast, and then you look forward again. So review your forecast at least monthly, if not weekly. And a really important one is document your assumptions that you're making about the future. So each month when you go back into the document, as I said, it's a living, breathing document. Each month when you go back in, you can have a look at what your assumptions were, what you were thinking, and then work out, well, was that wrong? Why did I assume that? And those gaps between what you assumed and what happened is where the big learning happens. And that's when you get to spot trends earlier than you think and maybe make adjustments for problems or opportunities coming up. Assumptions are the mother of all stuff-ups. So be conservative, as I mentioned. What we're trying to do is create a crystal ball for your business. And now that's impossible to be 100% correct. We're trying to stack the odds in our favor by using all this information and being conservative. And so I mentioned it just then, but reviewing your historical actuals versus your forecast. So going in each month and plugging in your actual result for the previous month and then updating the forecast looking forward is where a whole bunch of the learnings will happen. So don't just do this for 12 months and then forget about it. You need to be updating it monthly for what happened last month. And then you can be like, hey, look, I thought revenue was going to be great, but it's dropped. Why is that? It's questions like that that really help you start digging into the key drivers in your business. Then you can start adjusting, saying, oh no, look, our advertising's dropped. We need to pick that back up because our revenue's fallen through the floor and I didn't expect that. So yeah, the learning is in the space. How far off were you? But why were you off? What assumptions did you make? Great. Hopefully that helps you with some cash flow forecasting. This is a client of ours who went through the cash flow consultation, Dennis from Deposit Fix. The whole process and the whole picture are made clear. Now I understand when we can go with a new product to the market. And so we helped Dennis map out his path ahead, but he also got to plan a product launch and the staff that would be needed for it and plan how to make adjustments in his business. So for things like that, it can be really, really handy. It puts those ideas or dreams of what you're going to be doing into cold, hard reality, and you can build really definite steps towards those goals. Okay. Whew. Cash flow is over. Question time. What cash flow tip will get you more cash in the bank in 90 days? Have a think about it for your business. Are you going to be getting on the phone to some suppliers and being really nice to them and seeing if you can get that invoice paid? Are you going to be trying to stem the flow of cash from your bank account, reduce some expenses? Are you going to be mapping out using a forecast? Hopefully some of those helped you get more cash in the bank in 90 days. If you're not doing any of this, or you're not doing a cash flow forecast, I think you're flying blind. You really are. You don't know what's ahead, or you might have a gut feeling for some of it, but I can promise you, you're not capturing everything. So are you business A, flying blind, or B, have a clear game plan? And I sincerely hope that you're option B and you've got a game plan and you're sticking to it. If not, come and join us and do a cash flow consult. So profitability. This is section 2 of 3. We've got profitability and then debt coming up. There's an old saying, revenue is vanity, profit is sanity, cash is reality. So revenue is a vanity metric. If you made 2 million in sales last year, but it cost you $2.5 million to deliver on those sales, whatever it is, a product or a service, you went backwards. So your 2 million in sales is worth nothing because you're not a profitable company. Profit is where the rubber hits the road, and that tells you really how well performing your business is. But if you've made 2 million in sales for the year and 1 million of that is not in your bank account because the person hasn't paid you, that's where cash comes in. Cash is reality. Cash in the bank is the number one thing that everyone needs. So let's talk about some concepts to get you more profitable. Just a quick recap. I'm sure you all know, and you'll probably check. This is probably the number one most checked document for any business owner. A profit and loss shows whether a company makes money. This is, hopefully you're familiar with one of these. The boring accountant way to say it is the financial performance of a business over a particular period of time. So hopefully you should be getting one of these as a year-end summary. But if you should be in your books more often than that, you should be doing at least monthly profit and losses and analyzing where you're at. It's got your sales and it's got all your expenses. Here's a thought experiment for you. Could you double your prices and work with half as many clients? Let me know in the chat. Some people yes, some people definitely not. This is just a thought experiment. Yeah, it's an interesting one. I'd love to myself. Sometimes it's not realistic to double your prices, but let me show you a little graph that puts it into a more incremental way to think about it. So this breaks down a price increase versus customers leaving your business. So I don't want to get too much into the metrics or the stats, but what we're looking at here is your gross profit, and your gross profit is your sales minus your cost of goods sold, which is like your direct costs, how much it costs you just to get the product in the person's hand, ignoring all your overheads and stuff like that. So what we're taking is your gross profit margin, which is your gross profit over your sales. And so most business owners will be tracking their gross margin, I hope. A good example is a digital agency margins usually sit around 30%. Some softwares can be like 80% margin, but for a service-based business like an agency, let's pretend it's about 30%, give or take. So for an agency with a 30% gross margin, a 5% increase in your price, you can lose 14% of your revenue, and you're still fine. A 10% price increase, you can lose 25% of your customers leaving. You can see by just a 10% increase in your prices, you can actually lose a fair amount of customers and still be profitable. You're still in the same position from a profit perspective. I think this is a really interesting way to think about whether you can increase your prices. I know right now it's not a fantastic time to be trying to hike prices on people because it's a very sensitive time. A lot of businesses are doing it tough. But even incremental 5% increase, 2% increases, it has such a dramatic impact to your margins that it's definitely worth considering. And possibly it might flush out those poor performing customers who take up a lot of your time and don't want to pay you or don't value your services. That might be a good way to skirmish out a few of those, clean house, to the customers that pay you well, that you deliver a great service, and that it's a win-win for both. A quick accounting 101 on profitability. So as I said, sales less your direct costs equals your gross profit, which is what we're looking at in that table before. So if you hear, for example, you've built out a website for someone for 10 grand, your direct costs for the developers and all the hosting and stuff was about 7 grand. You got a gross profit of 3 or 30% margin, gross profit margin. So you've got taken your gross profit on the job, but you've got 2 grand of company overheads. You know, you might rent a office space. You've got a bunch of other things that the business needs to keep on top of. So 2 grand of that gives you a net profit of 10%, which is $1,000. So in another way to think about it, for every $10 you earn, the business keeps $1. But if we can get that margin up to 20%, that's net profit margin now. Every $10 you earn, the business keeps $2, which is twice as good. So let's have a look at some of the levers we can pull to increase your margin and let you keep more cash in bank. How do I get more cash in my bank? Well, you can increase your sales. There's 2 ways to do that. You can sell more stuff, so that's a volume-based strategy, or you can sell more expensive stuff, which is a price-based strategy. We did that thought experiment earlier about increasing your prices and working out how many customers might leave or who might leave and whether that's a good idea. But the volume-based strategy is obviously one that a lot of people try and engage in as well. That's the top line stuff. That's your sales. You can also reduce the costs or become more efficient delivering these sales. So that's where you're looking at cutting your expenses or just becoming efficient. So doing more for less, leveraging software, looking at those things like that. Some ideas to help you sell more stuff or the volume-based strategy. Amplify your marketing and demonstrate your value to customers. I was speaking to a business who, through the COVID period, advertising ROI went through the roof, and they really invested in marketing because less people were spending money on it. So they used it as an opportunity. But also, if you're doing this to try and increase your volume, make sure you're monitoring your advertising return on investment. Make sure you're actually getting value for the money you're spending. The classic one is to reduce your price to increase the volume, discounting. But just be careful with that, because you don't want to either get it in a price war with your competitors and a race to the bottom, because that's not good for anyone. But also you need to think about your perceived value to the market. And if people see you consistently discounting, they're never going to pay your actual price, which is what you're worth, because they know that you just discount it regularly. So be very careful with using discounting, because it does affect your brand. So for example, my volume-based strategy, to give an example in Bean Ninja's money mindset, is, we do online courses to help people implement Profit First. And that's a cheaper product that we aim to sell more of, rather than the one-on-one consulting, which is a more expensive product and we sell less of. So that's some ideas about the volume-based strategy. Your price-based strategy, so to get a better margin, increasing your prices. Remember that thought experiment. The way to come up with your price, one idea is a value-based pricing. So what is the value of your solution to your customer? See it from their lens. What is the value you're providing to them? How can you articulate that value to them in a convincing way? There's another strategy called cost plus pricing method, which means you built in your profit margin to have a minimum price that you'll charge at, and you can't go below that. That's a good one to know for if you're discounting or getting a price war. You know at least your floor with that before you start eating into your margins or becoming less profitable. Another idea is doing A/B testing on new products and prices. Throw it out there for a certain price to someone, throw it out there for another price to someone else. Maybe don't put it on your website, but test what the flavor for is in the market. Because quite often you can ask people. I've done tests with clients where we ask people and they say that sounds like a fair price, but the rubber hits the road when someone puts cash in your bank account. So you need to be actually enabling them to pay for this to prove that that's what it's worth. And when using the price-based strategy, think about whether your current customers can afford this price increase or how they'll feel about it. As I said, it might be good if you want a clear house, but if you've got loyal customers who are with you since the beginning and you want to look after them, think about how this is going to affect their business and whether you give them a holiday from this price increase for their loyalty. And so the price-based strategy for Bean Ninja's money mindset is, the one-to-one coaching is more expensive, but it's based on the value that I help my clients achieve. And another way to increase your margins is to reduce the costs required to deliver these sales. So I've mentioned this before, but staff utilization, tracking billable hours, reducing their downtime, calling your vendors to negotiate, I've spoken about, explore other options. Use your power as a customer or a consumer, shop around. Eliminate overlap. If two things are doing the same thing, obviously stop paying for one of them. If you've got, maybe sometimes software has multiple overlaps, two things could potentially be your CRM. Create systems to track and verify expenses. So one that I mentioned before was your advertising return on investment. Don't just throw money down the drain if you're not getting any leads or revenue in the door. This is Steve, who did a cash flow consultation with us. It was really handy for him because he has an idea about what's happening in February next year, and the feeling that I can start planning for that today is an empowering one. So Steve got a hell of a lot of value in the cash flow consult, and I'll explain a bit more about that further in the talk. Okay, what profit hack will get you more profitable in 90 days? So think about this for your business. Some with the pricing, some with the expenses. The expenses are good, but there's only so many expenses you can cut. You need to make sure you're running a lean, mean machine. But if it starts eating into your the service or product you're delivering, then you can't. You can only get to a certain level with it. But making sure we're efficient is definitely a good one. Great. Hopefully you've got some tips there to help you become more profitable. So, from the example I gave you at the start, do you want more revenue or more cash in the bank? Do you want 2 million in sales, but 2.5 million in expenses to deliver those sales? Or would you just like $500,000 in the bank? So it's about making sure that what you're doing is actually reflected in money in the bank in the most efficient way possible. Cool. I'm going to talk through quickly some debt management tips. What is debt? I'm sure you're all aware of it. Australia has some of the highest household debt in the world. For businesses, they can also be wrangled with a whole bunch of debt. That's credit card debt. That's bank loans. That's working capital loans. That's your government tax debts, or that's your mortgages, like your car loan. I went to a talk a couple of years ago, and he was a real estate buyer's agent, and he said that the most repossessed car in Australia at that time was a Range Rover, funnily enough, which I found fascinating. I'm based in Sydney. Maybe that says something about people overextending themselves in Sydney, or the need for an image, or maybe it's just a symbol of how expensive Sydney is. But I found that fascinating, and that car was the most repossessed. Might not be today, but yeah, it wasn't. What it was at that stage, apparently. So these are some of the debt holes people can get themselves into. And obviously you can get yourself into trouble if you can't make those repayments. And that's when people come and repossess your car. So do any of these sound familiar to you? You've got cash in bank, but you're still accumulating debt on your credit cards. You don't have any cash and you're using debt to cover your cash flow shortfalls. You're putting payroll on a credit card. Oof, that just hides that your business isn't profitable. That there's a problem in the structure with your business. You're not charging enough, or you're not delivering it efficiently, or you've got too many expenses. Using credit cards for points, but you don't pay them back in time. Credit cards can charge 17% interest on this stuff. It's insane. You need to be looking at this. Or you don't check credit card or interest charges on your profit and loss. They're an invisible expense in your business. You don't really monitor them. All you're looking at is your top line sales. You rarely look at your balance sheet where your debt lives, your credit card, your bank debts. And a big one is forgetting to put money aside for your income tax bill and then having to pay that off over the following 4 months, which stifles your cash flow that you could be using to help build your business, hire another staff member, invest in advertising. So if any of that sounds familiar, don't worry, you're not alone. That is very common. 2 strategies to pay down debt, the debt avalanche method and the debt snowball method. The debt avalanche method is to list out all the debts you have and you pay debts in order of their interest rate. So if you've got you're getting charged 17% on your credit card, pay that off first. Then go to the next debt that has a lower interest rate. Quite often, maybe the tax office debt will be the lowest. You might pay that off last. So that's doing it in order of what interest you're being charged. That's called the avalanche. Another idea is the snowball method, and that's all about getting momentum. And as you get momentum, the momentum grows and the snowball rolls down the hill quicker. So you find the debt with the smallest amount, the most achievable debt to pay off, and smash that one. You get that awesome sense of achievement that you've nailed one of them, and then you move on to the next one. So 2 different methods, and yeah, Google avalanche method or snowball method if you need some more info on that. Some solutions: you might be able to renegotiate for better terms, renegotiate the interest, renegotiate the installment frequency, or the length of when you can pay it back. You can stretch it out a bit more maybe. The best solution is to grow your business profitably from the start and then use the profits left over to fund your future investment. That's the most healthy way to grow your business. You might not be able to grow it as quick as getting into a bunch of debt and spending it all, but it's by far a safer, more stable, secure way to grow your business. And don't take on new debt to maintain business as usual. Don't get yourself into a hole trying to dig yourself out, getting into more debt. Have a look at why you're not profitable or why you need that money first. And then avoid credit cards if you can. Or have a system, a very strict system to pay it off before those interest charges. One solution in Profit First is to create a vault. So like I said, with those leftover profits, you create a separate bank account and put aside funds, ideally 3 to 6 months worth of funds of operating expenses in there. And you can use that in times of need or if you want to fund a future purchase. So I did mention that's the end of the 3 topics. I'll quickly talk through how Profit First can help with that. Quick question before we get started. What's your dream annual take-home pay? And this isn't like you being Instagram rich with a Lamborghini. I'm talking about like you're comfortable, you're happy, you don't have money stress, you're in a decent neighborhood, that kind of stuff. Just a nice, comfortable level. Okay. Now, have you got that figure in your head? So if you're the sole business owner, just to simplify this example, let's say that you're the sole owner of the business. If you want to pay yourself 80 grand, which is about, I think, the average in Australia right now, roughly, your business needs to be earning at least 200K to be able to meet all of its obligations as well as pay you that gradually. So your business doesn't need to make 80 grand for you to take home 80. There's so many other obligations in your business you need to be thinking about. So let's say you step it up and 150 grand is enough for you to live on, service your mortgage, feed your family, and be happy and comfortable. Then your required business revenue is 375,000. If you want to be earning $200,000, taking it home yourself as the owner, you need to be $500,000 in revenue, and it goes up from there. But this gives you a good guide about what the goal should be. This puts in a concrete reality what your goal or your income goal to help you live your best life, and then the target revenue that you should be aiming for in your business. This helps put it into a bit more reality for you, hopefully. So Profit First flips the classic profit equation on its head. I talked through the profit and loss earlier before. which is sales less expenses. What's left over is your profit. In the world of profit first, sales minus your profit equals your expenses. The critical difference here is that you're taking out a percentage to make your business profitable, and what's left over is what you have to pay your expenses. This plays into a whole bunch of behavioral dynamics that I won't get into the weeds with here. But probably the most obvious one is that if you have money in your bank account, you quite possibly are going to spend it. If you see it sitting there, you feel like you've got cash on hand, you'll start to spend it naturally. So this is about setting aside funds so you've got less in your expense account to pay out. And that naturally streamlines your expenses. Remember before, right at the start, I said, is spending this money moving you towards your ultimate goal? This helps really give you a laser focus on it because it's giving you less money in your account to spend on expenses. So a highline summary of how Profit First works is that you set up a few different bank accounts. This is the foundational 5. All your money or your revenue flows into one called the income, and you set up a different one for your profit, which is where you're setting aside funds to make yourself profitable, building in your margin immediately. Then you set up another one for your owner's pay, making sure you pay yourself. You're the most important employee in the business, making sure you pay yourself the right amount. And those are the kind of percentages I gave you before. If you want to be earning X, taking home that, you need to be earning that top line revenue. You set up one for tax. You need to be able to be meeting your tax obligations for the government. I spoke about debt and the government tax debts. You need to be putting aside funds for that. And then what's left over, you notice is at the bottom, is your operating expenses. And after you've taken away funds for all of those key things in your business, what you have left over is what you can use to pay expenses. If you don't have enough in your operating expenses at the end, that's telling you that there's something out of whack in your business, that either your expenses are too high or maybe you need to drive sales, and you need to look at actually the structural things in your business to become a really profitable machine. And then, if you're running out of money in your operating expenses, that's where you use some of the tips I spoke about in this webinar to help get you back on track. So how much should you be allocating? The $1 million question. And that's all. So this is all allocated out based on a percentage. So your income comes in the door, and then a percentage will go to your profit, a percentage will go to your pay, a percentage will go to your tax, a percentage will go to your operating expenses. So income is like 100%, and then it's divided up between these 4 accounts. So if your real revenue range at the moment or your income level, for simplicity's sake, is under 250K, then you should be putting aside 5% for profit. A 5% profit margin is a good starting point. You then put aside 50% to pay yourself, put aside 15% for taxes, and then the rest, which is 30%, can be used to pay expenses. The ratios change as your income level goes up, as you can see. And this is a rough guide. Industry to industry, this will change. Like a digital agency business or a service-based business, they've got high wage costs. The operating expenses are going to be higher than this. So this isn't a one size fits all. This is just a great example of a fiscally healthy business and a good starting point for you to start to think about how you compare to this. How does that tie into a 90-day plan? I've given you a huge range of tips and strategies to help drive your business to become more profitable. And this is the plan I think makes the most sense, step by step, to get you there. First 30 days, let's call it the opening sprint. I think you should build your cash flow forecast. If you've got one, you should be revisiting it, dust it off, do it regularly. Set some time in your calendar and do it. Once your books have been reconciled for the previous month, dive in and do your forecast for the next one, as I spoke about. If you haven't got one, I'll give you a link where you can book in to do a cash flow consultation with us. We can build one together. You'll get the template to do it. Preserve your cash. So this is where you're looking at all those ways to preserve your cash. Get more in your bank, stem the flow of it leaving. And maybe dip your toe into the world of profit first. Set up a profit bank account and just set aside 1% of all the revenue that comes in, set aside 1% of it to profit, just to get started, just to see that bank account start to grow. And you see how you're locking in a profit from the beginning. 30 to 60, let's call it the middle stretch. That's where you're going to, after you've done these most critical, time critical stuff, that's when you're going to look at what your goals are. You're going to look at what your key performance indicators are and what those things are that you should be monitoring regularly. Try and make it as easy as possible for yourself to monitor. So, we can help you build a dashboard to do that. But, there might be kind of 3 or 4 that you're measuring, but define why you're measuring those and think about it from a driver tree perspective, how those KPIs are flowing into the ultimate value of your business and how that affects it. I'd be doing a deeper expense analysis. We kind of do one when doing your cash flow forecast because we look at each expense line, but do a deeper dive in your expense analysis and have a look at if you need to be committing to all of these expenses. And then also look at your pricing and your margins using some of those concepts I spoke about earlier. If you can increase your prices, that's great. See how the strategy for that. Or if you can deliver what you're doing more efficiently, start to implement some of that in the middle stretch. And then the run home, 60 to 90 days. That's where you look at destroying your debts. Work out a debt payment plan. Look at renegotiating your terms. Maybe you've set up your profit bank account and you can see that 1% growing each time you're allocating. Maybe set up a vault for your future costs and allocate some of your leftover funds into there, setting aside that war chest for the rough times. Or you could use that war chest to invest in your business in the future. But you're building in a buffer that you don't need to rely on debt. And I would say when I asked about what's driving the profit in your business, have a look at who your top 5 customers are. Can you add more value to them? Can you upsell to them? And start to look at those business growth things at the end of this 90 days. And that'll flip you into the next 90 where you reset and do it again. So I'm going to challenge you. I know there was a lot of information here. Thank you for sticking around if you have this long. Is there one thing you can action right now? There's got to be, I've given you a lot there. Is there one thing you can do? Is there one supplier you can call right now after this finishes? Is there one customer that you need to look after better, that you need to call and be like, I value you. How are we helping you? Can we do better? Maybe it's just that. If that's all that happens after this, I think I've done my job. So if you're on the slow track to business success, you're trying to nail away at this on your own, trying to come up against these problems and working out a best solution, or you can get on the fast track. I'd love you to be option number B on the fast track. So if you need help with planning for future growth, having your house in order, getting your bookkeeping sorted, getting those processes nailed, becoming consistently profitable, working out how to do that. Do you know when to hire staff or how to monitor staff productivity? Like a metric we can use for that? Or if you're just setting up for sale or future investment, if you want to sell your business or you want a bank to lend you funds, you need to show them at least 2 years worth of your financials. So you need to get your financials in order and looking good in order to do this. Or if you need help building some operating procedures for your finances to get that whole arm of your business running smoothly, then I think you need to get in touch with us. The fast track, the most important one, I think, if you haven't got one right now, is the cash flow forecast. So I'm offering 1.5-hour cash flow consultations right now. I mentioned them before. And you can invest in a 12-month game plan for your business. You walk away with a forecast, the actual template that we build based on your numbers. I'll give you a recording of the call. I can give you optional ongoing support. We can do this monthly and do a review together as well. And it's only $300 USD. You can get started today at bninjas.com/cashflow consultations. And you can see that link there. I'll also post this link in the comments below. So then you'll be able to get it. Great. Thanks for watching.